Hello, my young economic professors. DD Jato is my name, and as usual, your facilitator for economics at Omega Vacation Classes. Today's topic is a continuation of our previous topic, national income. And I hope you remember all the details of what we discussed in our previous lesson. So we will do that, okay, by a quick recap of our previous session. And please take note that you will need the following items to successfully go through this topic. You will need your jotter, your calculator, pen and pencil as the case might be. Right, so a quick recap of our previous session. Answer the following questions. What did we say national income is? Write it down in 1 minute. Awesome. The next question is that list the methods for computing national income in 1 minute. Great work done. The next question is that quote the formula for computing national income using the expenditure method. Okay, so let's take them one after the other. Compare your answers with what I'm going to say. Right, so national income we mentioned simply as a total monetary value of all produced goods and services in a given nation over a given period of time, usually a year, right? And then we identify three methods or approaches or procedures in the computation of national income. And these are the expenditure approach or method, the income method, and then the product method, right? And then we looked at the expenditure approach extensively. So we are going to concentrate on the expenditure approach and then pick a data and use it in its computation. All right, so let's get started. So now the expenditure approach. So we said the expenditure approach computes national income by summing up all the money spent by all economic agents in a given economy. So once we do that, we arrive at the expenditure approach in the computation of national income. And take note that there are three economic agents in here: individuals, firms, and governments. So all their expenses, when we put them together, it all amount to the national income of the country. Bear in mind that whatever we spend will be on produced goods and services within the country, right? So let's look at the formula for computing the national income using the expenditure approach. So let's compare. So the first step in computing national income using the expenditure approach is the GDP. So GDP NP, which means gross domestic product at market price. And we'll compute that by summing up all consumers' expenditure, and then we add the investment expenditure, which refers to the expenditures made by firms in the production of goods and services. Then we add that to G, which is government expenditure. Then we add all the value of exported goods and services out of the country. And then we deduct the value of all imported goods and services into the country. So that gives us the gross domestic product at market price. Take note that gross domestic product has to do with all the expenses made within the geographical borders of the country. And these expenses will include foreigners' expenditure and then also citizens' expenditure. And take note that it is at the market price, meaning when we get a GDP NP, this value or figure is influenced by taxes and then also subsidies. So they do not actually portray the true expenses made by economic agents, because any item that you buy has either a tax or subsidy. The taxes, which are specifically indirect taxes, will inflate the prices of goods and services, whereas subsidies will reduce the prices of goods and services, hence reduce expenditure. So the economists will like to know if there are no taxes and there are no subsidies, what would be the true value of economic agents expenditure? If there's no tax, if there's no indirect tax on water and the food that you buy at restaurants, or there's no indirect taxes on the electricity that you pay, what will be the actual expenses of economic agents? And then also, if there is no subsidy granted by the government, like subsidies like free SHS and then that of health insurance, what will be the actual costs of expenditures made by economic agents in the country? And that is why the economists will move on from the GDP NP to what we call the GDP once again, but this time at factor cost. So we'll call it GDP FC. So in arriving at the GDP FC, we pick the previous GDP NP. So we have the GDP NP, and then the subsidy that the government granted, we bring it back by adding it. And then the taxes that the government imposed, we subtract. So it becomes GDP-FC becomes GDP-NP plus subsidy minus indirect taxes. Then the next stage is what we call the GNP, Gross National Product. Once again, at factor cost. Now take note that I mentioned earlier that the GDP is all the expenses made by all economic agents residing in Ghana. And we know that there are foreigners in Ghana, either individuals or foreign companies in Ghana, and they are making a lot of expenses in the country. So the GDP that we get includes those expenses made by foreign companies and foreign individuals, as well as Ghanaians who are residing in Ghana. But then this does not paint a true picture of what really belongs to only Ghanaians. So if we want to know the actual value of Ghanaians' contribution to the economy, then what we need to do is that we go a step further to compute the gross national product. Gross national product is the total amount of money spent by all the citizens of Ghana, whether they are in Ghana or abroad. So then we pick the GDP NP once again. Sorry, we pick the GDP FC, which has foreigners' contribution. Okay, so we pick that and then deduct expatriate factor income. The expatriate factor income refers to all the income received by foreigners, either individuals or foreign companies in Ghana, and then they spend that money in Ghana. So we need to deduct it. We deduct it from the GDP FC. And then once we do that deduction, we must also go all over the world and then search for our citizens and then add their expenditure, which we call the ICA, which is income of citizens abroad. Now, we are using income because the amount of money that our citizens abroad receive, they spend them. So once they spend, then we need to go and then search for their expenses and then add. So to arrive at the GNP at factor cost, we need to take the gross domestic product at factor cost, deduct the foreigners' expenses or foreigners' income, which is the expatriate factor income, and then we also go and then search for our citizens abroad, and then we bring their income back. This gives us truly what belongs to only the Ghanaian or only the expenses of all Ghanaians or all citizens of a given country, both residing in the country and then residing abroad. Then the last stage in the computation of national income using the expenditure method is what we call the NNP, which is the net national product. Once again, at factor cost. Right. So in order to get this, we go and pick the GNP that we computed previously. So GNP, once again, at factor cost. and then we deduct what we call depreciation. Depreciation simply is the wear and tear of capital assets when they are used over time. So roads, machinery, buildings, and so on and so forth, when they are used in the course of the year, they undergo wear and tear. So we need to estimate the amount of depreciation that these fixed assets have undergone, and then we deduct, and that is what will give us the final value for the national income. Right. So I hope all the variables have been explained in here. Right. So that said, we are going to look at a particular data and then do some mathematical gymnastics regarding that data. So take your calculator, take your pens and pencils, jotters, and let's go through together. Okay, so this is the data. So the first question is that compute GDP NP. So observe the data carefully, and then we do the computation together. Okay, so let's get started. So do that in 2 minutes, and then you compare your answer. So pause the video, and then compute it in 2 minutes, and then come and compare. Awesome work done. So we are computing GDP NP. So we write GDP, the formula, NP, and it is equal to consumption expenditure plus investment expenditure plus government expenditure plus exports, and finally minus imports. So that is the formula for computing GDP NP. So this is how we go about it. You need to write each item and its corresponding value, and that must be done vertically to make your work more decent, clean, and clear for the examiner to read, mark, and award you the score. So consumption expenditure, we write in full. Now, for want of space, I will be using abbreviation, but you'll have to write everything in full. So consumption expenditure is given in the data as 593. Okay, so 593. Now, take note that if you write only 593, the examiner is going to mark it wrong. Now, let's observe. There are 3 zeros here. And what it means is that all the figures that we have here must be followed by 3 zeros. So it is mandatory that you add the 3 zeros to each of the figures. So this is not just 593, but 593,000. Okay. So the next one is investment. So you write investment expenditure, you write in full. Okay, so we identify the value for investment expenditure, and that is given as 230,000. So we clearly write 230,000. Great. Now the next item is government expenditure. So we write our government expenditure. Please take note, I keep saying that you have to write in full. So government expenditure, let's identify that. So government expenditure is given as 847,000. So write 847,000. Now take note how all the values are carefully aligned. Okay, so we have 847,000. The next item is exports. So let's identify our exports. So exports here is given. So we clearly write our exports. So this is a short one, so I can write in full, but know that you always have to write in full. So export is 392,000. So 392,000. Right. Now the next item is imports. So we write our imports. And then the corresponding value attached to that is import. Where are you? Okay. So import is given as 291,000. So we have 291,000. Okay, so when we are done, we underline. Now take note of this. Take note that we are adding this, and then the sign must be indicated clearly. Okay, and this is a minus. Okay, so in 1 minute, you do that and do the computation. Let's see what you get. Okay, so let's do it together and see how you arrive at your answer. So we have 593,000 plus 230,000 plus 847,000 plus 392,000 minus 291,000. Okay, so that gives us 1,771,000. So 771,000. So that is our answer for the gross domestic product at market price. So GDP, NP. Okay, bravo. If you got it right, excellent work done. Okay, so let's move on to the next step. So that's the first step. The next step is this. So the next step is compute GDP FC. So once again, we quote our formula for GDP FC. So GDP FC, to do the computation, you have 1 minute to do so. Right, so compare your answer with it. So GDP FC is the previous GDP NP. So go and pick it. GDP NP. Okay, now plus subsidy minus T, which is the indirect taxes. So you must always take note that it is indirect taxes that we deduct. So we compute further by indicating GDP NP. Then we write the corresponding figure, which we had as 1,771,000. Okay, and then we'll go and identify the subsidy. So subsidy, we write subsidy. So what's the value for subsidy? Subsidy, where are you? So our subsidy is 78,000. So we indicate 78,000. Now look at the alignment of the figures. It is very, very critical, right? So that is a plus. So you indicate as a plus. Now the next one is indirect taxes. So we have indirect taxes. So I am abbreviating. You cannot abbreviate. So indirect tax we deduct. So let's go and find the value of indirect tax. So indirect tax is 105,000. So 105,000. Okay, so once we are done, we underline and then we write the final answer. So we have 1,171,000 plus 78,000 minus 105,000. Okay, so that gives us 1,744,000. Okay, so we indicate that 1,744,000. Okay, bravo. So you see how easy it is. Once you know your formula, you just write them and then substitute the figures into it. Right. So the next step is the computation of the GNPFC, gross national product, at factor cost. Okay, so let's do the computation. So code the formula for GNPFC. Take note that the GNPFC will compute the value for only the nationals. So code the formula. So GNPFC is going to be the previous GDPFC. So we'll pick the GDPFC. Okay. And then we subtract the income or expenditure of foreigners, which we consider to be the expatriate factor income. And then we add the income of citizens abroad. Right. So now we indicate our formula, we indicate the values. So GDPFC So it was the value that we got for the GDPFC, right? So that is, sorry, there shouldn't be equal sign here. So the GDPFC is 1,744,000. Okay. Now, so the next item is the expatriate factor income. So let's find the expatriate factor income. Okay, so that is provided over here. So we write in full expatriate factor income or income of foreigners, as it might be indicated. And the figure here is 326,000. So 326. So 326,000, and take note that it is a minus. Then we identify income of citizens abroad. You write in full, remember. So income of citizens abroad. Okay, so we identify that here. Okay, as 432,000. So 432,000. Okay, and that is a plus. So we'll do that computation. So let's see what we'll get. All right, so 1,744,000 minus 326,000 plus 432,000. Okay, so when we do that, we are going to get 1,850,000. So we clearly write 1,850,000. Okay, great work done. So that is the gross national product. That is what really belongs to the Ghanaian or the citizens of the nation, right? So the next step is the computation of the national income itself. So let's compare what you did with what we are going to do. So we compute the net national income. So state the formula for the net national income. All right, so NNP, once again, at factor cost is going to be the GNP that we computed earlier minus depreciation. So we identify our GNP. So GNP value is our GNP value is 1,850,000. 1,850,000. Okay, then we identify our depreciation. Okay, and then know that we are deducting. So where is depreciation? Depreciation. Okay, so the depreciation is 32,000. Okay, so we underline and then put the final answer there. So 1,850,000 minus 32,000. Okay, so that gives us 1,818,000. Okay, so that is our national income. So that is how we arrive at the national income, right? Now, please take note that there is an item here that we did not include, pensions, right? Now, pension is the amount of money that people receive when they are on retirement. Please take note, pension is the amount of money that workers who have worked previously receive currently that are on retirement. Now, take note that national income refers to the amount of money generated or spent or gotten from current production of goods and services. Pension monies are excluded in the computation of national income computation. You neither add nor subtract because those who are receiving that amount of money are not contributing to current economic activity. So you leave it as it is. Sometimes it's just brought there to confuse you. Yes, it is an expenditure made by the government, but because that expenditure is not for current production of goods and services, that is excluded. But when the pensioner receives the money and the person spends the money on various goods and services, that will be captured as the pensioner's expenditure. Because, for instance, if I go on retirement and receive 500 cedis every month, the money that the government is giving me, the government must not capture it as part of its expenditure because the government is giving me the money for free for not contributing to current economic activity. However, if I receive the money and then use the money to buy electricity, use it to buy water, use it to buy food, use it to buy petrol for my vehicle, use it to pay for mending of my shoe, repair of my house, and so on and so forth. That will be considered as my expenditure. So the 500 will be captured from my perspective as expenditure. Okay, but not from the angle of the government. And so the expenses by all the pensioners will be captured under consumers' expenditure. Now, if that is not done and is included in the government expenditure, it will amount to what we call double counting, and that will overestimate the national income statistic. So in national income accounting, we exclude what we call transfer payments. And transfer payment is any amount of money that is given out for no commodity or service rendered. Another example of transfer payment is that of the pocket money that you receive from your parents. You don't work for those pocket money. You don't render service for those pocket money, and you don't give goods to your parents for receiving those money. If an uncle visits and moving or going away and gives you, hey, Abena come and gives you 100 cedis, that should not be considered as your uncle's expenditure because you did not render any service or provide any good for that particular amount of money received. So all transfer payments must be excluded. We'll talk about it more when we get into the problems associated with the with the expenditure approach. All right. So that is it for our computation for national income on this data. I hope you understand it very well. Right. Now let's look at the next fifth question. Compute net export. Net export. Okay. Now, net export simply refers to the difference between import and export. So the formula for net export is simply export minus import. And that is found in the formula for the GDP NP. So it is simply exports of goods and services, the value of exported goods and services, minus the value of all the imported goods and services. Now, take note that we always have to subtract imports because the commodities that we import in the country are not commodities generated in Ghana, so they are not part of our produced goods and services. Right, so net export, if you write the formula, we're going to find the values involved. So export value is 392,000 minus import. Value of imports is 291,000. 291,000. Okay, so that's, we find a difference. So find a difference, let's see what you will get. Okay, good work done. So next export, let's do it again and then confirm our values. So 392,000 minus 291,000. So that gives us 101,000. That's net export, right? Now the next question is compute that of net indirect tax. So net indirect tax. So the formula for net indirect tax is also captured in the formula for that of the GDP FC. So net indirect tax, I'll use abbreviation for want of space. Net indirect tax simply is subsidy. Always write in full. So subsidy minus the indirect taxes. Okay, always write in full. So we'll go through our data. We find our subsidy. So the subsidy value is 78,000. So 78,000 minus the indirect taxes, which is 105,000. All right. Now, please take note of it because we're using the values in our subsequent computation. So our net indirect tax, 78,000 minus 105,000. That gives us a negative 27,000. So we clearly write our negative. Please take note that it is negative. So negative 27,000. That is our net indirect tax, right? Now, the next question is that compute the net property income from abroad, or net factor income. Net factor income is also found in the formula for gross national product, okay? And the formula for net factor income is, so we write our net factor income. I'm going to use abbreviation. You have to write in full. So net factor income is equal to income of citizens abroad minus expatriate factor income. That's what we call the net factor income from abroad, right? The amount of money that our citizens are receiving or spending abroad minus the amount of money that foreigners are spending or receiving in the country. So our income of citizens abroad in this data is given as 432,000. And expatriate factor income in this data is 326,000. Okay, so when we find a difference, 432,000 minus 326,000. Okay, so that gives us 106,000. So you clearly indicate your 106,000. I hope my computation is right. So this is how you do these extra computations. Now take note that sometimes in the data that will be given, you will not be given exports, imports separately. You will not be given subsidies, indirect taxes separately. You will not be given income of citizens abroad and then expatriate factor income separately. The subtractions or the differences might be found for you. Okay, so you have the value of net exports, you have the value of net indirect tax, you have the value of net factor income. When these nets are given, you will have to add at the various stages or various steps in the computation. So let's have an example of that. So let's observe the next data. And then based on that, we'll do our computation. So the next data is this. So that's what I just mentioned. Take note that you have been given net indirect tax and you've been given net exports and then also net property income from abroad. These are the computations that we did earlier. So when these are given you, you don't have to go and then write exports separately, imports separately, income of citizens abroad separately, income of foreigners, subsidy, indirect taxes separately. You will just have to add at each of the stages. So let's try our hands on this and then see how it goes. So the first question is that compute GDP at factor cost, GDP at market price. GDP at market price. So quote the formula for GDP at market price. Awesome work done. Great. So our GDP at market price is this. So GDP NP. So you realize that we have consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. Now take note that there is no export and there is no import in this data. And that explains why you need to omit this part and then you have to add. So you have to add net export. So the net export has been given here. So we then add net export. So plus net export. And then you will have to write in full, as I keep mentioning. So our computation is going to be this. Consumption expenditure, always write in full. So consumption expenditure here is given as 593,000. Plus government, plus investment expenditure. So write also in full. So investment expenditure. So our investment expenditure is given as 23,000. Okay. Now the next item is government expenditure, and government expenditure is given here. So remember to always write in full. Government expenditure is given as 847, sorry. So 847,000. Okay. So this is where you have no export, you have no import. So the value of the net export. So you just write net export. So net export value is 101,000. Okay. So then you underline and then you provide your answer. And you realize that your answer is going to be exactly the same as what we did earlier, which is 177,000, 1,000. Okay. So this is how we go about it when the individual items for export and import have not been provided. All right. So let's move on to the next step in our computation. So the next question is that compute the GDP FC. So in 1 minute, you compute that. Great work done. So let's compare what you got with what we have here. So the GDP FC is going to be the GDPMP that you computed earlier. Right. Plus subsidy and then minus indirect taxes. Now, if you go through the data, you realize that there is no item for subsidy and there's no item for indirect taxes. And therefore, it will be out of place to do this. So once you have this given, and the difference has been found for you already, and it's given as net indirect tax. So what you do is that you add. So this becomes GDP NP plus net indirect taxes. So plus net indirect tax, you have to write in full at all times. So our GDP MP that we got was 177,000. Okay, so plus the negative 27,000. Okay, so then you provide the final answer. So you realize that when you do that, you are going to get the same as our previous answer, which is 1,744,000. So take note of these. Okay, great. Now, the next question is that compute the GNP at factor cost, GNP-FC. So what's the formula for GNP-FC? Solve that in 1 minute, and let's see what you get. So GNP-FC formula, let's compare what we got with what we have here. GNP-FC formula is GDP-FC plus income of citizens abroad minus expatriate factor income. Okay, but if you go through the data, you realize that there is no income of citizens abroad given separately, and then also expatriate factor income given separately. So the difference has been found for you already, and it is captured as income of citizens abroad. Net property income from abroad. That's how it's been captured. So in this case, it will be out of place to use ICE plus ICA minus EFI because you don't have the individual items. So therefore becomes plus GDP-FC plus the net property income from abroad. Okay, so that's how it's going to be. So you pick the previous figure and then you just add and then you are good to go. So this is how we do our computation regarding the expenditure approach in the computation of national income. Right, so from there, now you can go ahead and compute your NNP-FC by picking the GNP-FC and deducting depreciation. So NNP-FC therefore becomes NNP-FC okay, is GNP-FC, right, minus depreciation. So that's it. Then you are good to go. So always observe that you will not always be given all the items, but the differences should be found for you. If the differences are found for you, all that you need to do is to add. Just add them at the various stages and you get your responses to be right. Okay, so we have per capita income here. Population has been given. We wouldn't do that computation. We'll look at that in our next session. Right, so on that note, we will end our session here. Right, thank you very much for listening in to this lesson and your contribution. Right, have a most fruitful day. Bye-bye.